Good morning, girls. So, we're going to see another topic today on life insurance. So, in the last class, I have taught you all, explained to you all the meaning of insurance, and then we're also seeing the various principles of insurance. So, in today's class, we're going to see the evolution of life insurance. Okay, so how the evolution of this insurance, life insurance especially, happened, and what were the different types of policies, and how the changes were made and amendments were made in the insurance policy is what we're going to see in today's class. But before I could start off with the evolution of life insurance, I would like to recap on what exactly is life insurance. Okay, see, life insurance is nothing but a contract between the insurance company and the policyholder. All right, so wherein the policyholder continues to pay a certain sum of premium, all right, a certain sum of amount periodically. Okay, maybe it could be once a month, or rather 2 months once, or 3 months once. It depends on the policy. All right, so the premium is paid by the policy holder on a continuous basis, and then on the lapse of the insurance period, okay, rather in the lapse of the policy, he would get back the handsome amount, okay, that which he has invested. That is, in case of life insurance, as far as life insurance is concerned, on the death of that person, okay, who has insured his life, his beneficiary, okay, is dependent, whomever he has made as the beneficiary, will receive the set amount. Is that clear? So this is what is called as life insurance. It's nothing but insuring the life of a person, wherein he would continuously pay premiums, okay, in return after the lapse of the time limit, or rather on his death, okay, the beneficiary would receive. In case he doesn't die within that set period, within that policy time, after the lapse of the policy, the amount would be given back to him. Okay, it would be paid out to him. So this is what is basically an insurance. Okay, so in today's class, like I told you, we are going to see the evolution of life insurance, how it evolved, what were the types of policy which was available, and what is the current type of policy that we are having. Okay, so in earlier days, the first kind of policy, as far as life insurance policy was concerned, was available, was your term plan. Okay, so what is this term plan? So in this term plan, okay, this is a planning for a particular time period. Okay, so in this what are the principles, we'll see in detail now as far as term plan is concerned. Now this is the first ever form of pure protection. Okay, uh, pure protection in the form of term plan for the insured person was available. Now according to this policy, it will pay only on the death of the policyholder. Okay, it will pay the compensation, it will pay the insurance cover only on the death of the policyholder. Okay, so this was the first type of plan I'm telling you all about. Today whatever we are having is different. Okay, but in those days when the insurance policy was ever like came into existence, at that time we had this one type of plan, wherein in this plan only if the person dies you will get back the compensation. The next one is principle is lowest premium was paid. Okay, so premium that every month or every interval, at regular interval you are supposed to pay, was very low, but you will get a very big payout, highest payout according to this plan. And if you survive the term policy, you will never receive any payment. So that was a big drawback of this particular plan, I should tell you. So if at all you are going to survive, okay, the set term period, meaning say for example if a person has insured his life for 30 years, so within that 30 years if he is not dead, he will not get back anything. But if he dies, he is going to get back a good compensation. That means, as in, like, he will not get it, the beneficiaries will get a good compensation, a highest compensation. Then another important thing is there was no reinvestment at all made in this particular plan. Okay, so whatever was collected by the insurance company was kept as it is. Okay, it was not reinvested like how today's insurance companies are reinvesting in equity market or in fixed deposits. Like that, it was not reinvested at all. There was no reinvestment made. The amount was simply kept back with the insurance company, and it was a pure insurance policy. Okay, on the death of the person only they will give. If the person does not die, it's a benefit for the company. It was like that. So this was called as the pure insurance plan, pure insurance policy. It is called as term plan. I hope I made that clear. So that was one of the types of insurances which was available. The next, they came up with something called as endowment policy. Okay, so what is this endowment policy? In the sense that, see, some people felt it was a waste to invest in term plan. Obviously, if that person dies only, you will get back the investment. If that person does not die, you will not get back anything. So it was a waste. They thought it was a waste to invest in the term plan. So what they did was, they wanted the insurance company to come up with a modified plan. Okay, so therefore insurance company came up with their modified plan and came up with this policy, which was called as endowment policy. Okay, so in this endowment policy, what were the principles were, what are the rules were? The premiums were higher when compared to term plan. So I already told you, in term plan the premium was very low rate of premium was paid, but the payout was very big. But here in this endowment policy, the premium was higher when compared to that of term. Not too high, but when compared to term plan, it was increased. Then other than that, part of the premium will go towards insuring the life, and the rest was reinvested. And also made a mention in term plan that there was no reinvestment as far as term plan was concerned. But in endowment policy, they went for reinvestment. And where did they reinvest? They reinvested in fixed forms. Okay, in your fixed income, these things. Like for example, today we have a fixed deposit, isn't it? If we invest in fixed deposit, we are going to get back interest every month. So like that, they went in for reinvestment. The insurance company went in for reinvestment. And then this policy will pay the beneficiary on the death of the policyholder, and even if the policyholder survives the policy, he will still receive the amount on maturity. Okay, so all the drawbacks of the term plan was kind of covered in your endowment policy. Okay, so in term plan, one more thing that I made a mention is, if the person survives the policy, he will not get back anything. Only if the person dies, then his beneficiaries will get. But here, if the person survives the policy, even then he will get back the money. Did you understand? So that was the modification which was made in endowment policy. The next kind of policy that they came up with was money back policy. So what is this money back policy in the sense here? While term plan met the need of pure life insurance, endowment policy met the need of payouts on survival. Okay, still there remained a gap between what is called as pure life insurance and payouts. Okay, there was still a gap. So what was the gap was, some people wanted interim payouts, meaning in between the policy they wanted some kind of amounts. Okay, they wanted some payouts. So they came up, the insurance company came up with this particular money back policy. So according to this policy, what happened was, so like some people wanted the interim payouts on the surviving part of the term. People didn't want to wait until the end of the policy period. Okay, so that's when this particular policy was born, giving interim payouts depending on the survival of a certain period. Like for example, if the policy is for 20 years, okay, on the survival of 5 years, there will be a payout. Again at 10 years, there will be another payout. At 15 years, there will be another payout. So like this, interim, in between, at regular intervals, they used to pay out from the policy. So that was only what was called as money back policy. Did you all understand? So next one is ULIPs, that is unit linked insurance plans, and ULPPs, that is unit linked pension plans. So this is another policy that we saw before, like endowment policy. Okay, so like endowment, money back, they all gave back low rates of return. Okay, and invested in safe fixed incomes. But this particular insurance company wanted, so your ULIPs and ULPPs came up with another kind of diversification. Okay, like I told you, money back was to give back some kind of interim investments. Okay, and then your other kinds of plans like pure insurance was only to give up insurance, and then your other policy was your endowment policy, so that came up with giving back even on the survival. Okay, so with this they also now came up with another kind of an extension or diversification, and that was to come up with investments into equity. Okay, earlier these kind of other kind of policies were trying to invest in safer reinvestments, but now these ULIPs and ULPPs came up with equity investments, which is completely risk oriented, but at the same time these give back higher rates of returns. Okay, so this policy more was invested into equity and less towards the actual payment of life insurance. Okay, and it was a saving based and market linked investment. Did you understand? So this is about the ul ULIPs and ULPPs. So this is about the various evolution that your insurance policy took up. Okay, the various amendments. So the first thing you saw was in pure insurance, in term plan, there was only if the person dies you will get back the thing. That was initially the thing. Then endowment policy, they came up with a amendment with a change that even if the person survives, he will still get, just that the premium rates were increased. Then they came up with money back. Okay, so money back, whenever they wanted they can take some money also. Okay, money back also. And then lastly is ULIPs and ULPPs. So these were like trying to invest in riskier investments in order to give back higher rates of return to the policy holders. Okay, so this is how it evolved, and today if you see, most of the insurance companies are up to these kind of investments where they're going in for most of your reinvestment of an insurance company is happening with the equity, that is with the shares. Okay, because shares are having high rates of return. Of course you're riskier, they can give you also low rates of return, but then the risk is not imposed on the policy holder, rather it is taken up by the insurance company. Okay, but at the same time they are earning high rates of returns. When risk is high, the rate of return also is high. So that is a what to say, the policy as far as risk is concerned. So therefore this was the evolution, and this is how it evolved, and today most of the insurance companies are following these kind of reinvestment tricks. Okay, so now we'll also continue to see the simplified life insurance terms. Okay, the terms of the life insurance, which will make you understand it more clearly, the terms that we are using. So life assured is nothing but the life protected. Okay, the is not nothing but the person whose life is covered. Okay, the life assured is the person who will be covered under the insurance policy. Now it sometimes might be where this now for example I myself can start up a policy for me, and I can pay for myself, or rather I can also pay an life insurance for my son. Okay, by somebody else. So whomever, on whosever name you've taken the policy and you're paying, that person is the life assured. Did you understand? The next one is proposer. So who is the proposer? Proposer is the one who is paying the premium under the insurance policy. Okay, it can be the person who is assured, or it can be the person who is paying for somebody else. Alright. The next one is nominee. Who is the nominee? Nominee is the person who will receive the benefit. Okay, the death benefit. Usually it will be like a husband would make his spouse or make his children as his beneficiaries. So whomever name is written as a nominee, they will only receive the benefits of the policy. Next one is date of commencement. So date of commencement is the start date of the insurance policy, when the insurance policy ever started. So there will be a time period, isn't it? So 15 years means, so what is the starting date? Okay, that is the one. Then sum assured. So what is the sum assured? Is nothing but the amount which the insurance cover is taken for. Okay, so it will get under the policy, you will get under the policy what the nominee will get back. Okay, under the policy, that is what is called as the sum assured. Premium is the amount, okay, that will be paid under the insurance policy for getting the insurance cover. every month or every quarterly, whatever according to the time interval that you have entered into with the policy. So whatever is the amount that is fixed regularly, what you're supposed to pay is called as a premium. The next one is term. Term is the duration of the policy, till which the policy is valid. Okay, till when the policy is valid. If you enter for 15 years or if you enter for 20 years, so that this is a term. Next one is premium paying term. Okay, till when you have to pay the premium. See, one thing you have to remember, girls. Now supposing if you take up a policy for 15 years, it's not necessary that for 15 years you will pay your premium. Okay, but rather there is a premium paying term. Only till that time you have to pay. Say for example, if you entered into a 14 years plan, they would say that you have to pay the premium for 7 years. Now after that 7 years you will stop paying your premiums, but only after 14 years is covered by the policy you will get back your compensation. Did you understand? So that is what is called as a premium paying term. Only till which term you will pay the premium, that's called as a premium, but after that the term will still continue for the insurance policy. The next one is mode. Okay, so mode is the frequency of the premium payment, meaning whether it's monthly, whether it's quarterly or half yearly, depends on the policy that you have entered into. So based on that you will pay. So that's your mode. Then maturity date. Maturity date is when the insurance policy will mature. Okay, is a date when all the benefits under the life insurance will cease and will no longer, the policy will exist. That's called as the maturity date. Okay, the next one is survival benefit. Okay, so survival benefit is the amount which is payable in case of the money back policy. Okay, meaning the amount is paid as a benefit after every few years during the term. I told you about this particular policy, money back policy, where like after a particular term is over, you will have to pay your they will pay your money back. So like that, this is under this particular term you will use under that particular endowment payback thing. Okay, money back policy. That is the 5 years once they will pay, then 10 years once, 15 years once, whatever is the time limit that you enter into, like that for. Okay, so that's about the survival benefit. Next one is surrender value. So what is the surrender value? Surrender value is nothing but the amount you will receive in case you do not wish to continue the policy. Okay, you entered into the policy 15 years, but in between you don't want to continue the policy anymore. Okay, so your life insurance will never say that, okay, if you discontinued a policy, you're not going to pay back anything. Okay, so that is what is called as the surrender value. Sometimes you will not want to continue. You may not be in the state of paying your premiums. At that time, you can just get the surrender value. Stop the policy and get the surrender. Whatever it was collected and whatever is the compensation you're supposed to get, that will be paid back to you. Okay. Next one is fund value. So what is this fund value? Fund value is applicable in case of unit-linked insurance plans only. Okay, unit linked insurance, I told you the last one, ULIPs. So in this, whatever is the market value, because I told you the reinvestment according to this particular policy, ULIPs will happen only in stock market. So stock market is based on the market value. The value of the shares, the value of the investment as far as stock market is concerned will fluctuate, and that will be the market value. So fund value is nothing but if you are going to take up these kind of ULIPs, okay, so that in that you will find this fund value which will keep differing, fluctuating. Okay, and that is what is the market value. Next one is the maturity value. Maturity value is the amount which you will receive at the time of the maturity of the policy. Okay, once your policy matures, whatever you're supposed to receive, whatever you have entered into the contract with the insurance company, that particular amount you will receive, and that's what is called as a maturity value. Did you understand, girls? Okay, so this is the various simplified life insurance terms. Okay, so if you properly went through this, you will be able to understand your insurance very well. Okay, so that's about your the evolution of life insurance and the terms of life insurance. Thank you.